Politics have never been this volatile in my lifetime. But I think there's one thing that both sides can agree on. We don't want to give any more money to the government than we have to. So I think it's safe to say that in my lifetime, this is the most political vitriol I've ever seen in my life. Both sides just can't stand each other. But I think it's pretty safe to say I've seen clients who are Democrats, Republicans, Libertarians, Socialists, all that. The one thing that everybody wants is to ensure that they're getting the most they can and not giving it to the government in the form of taxes. So, and if you're one of those, you think you should be paying more to taxes, let's talk first. Maybe you can give me the money, and Papa needs a new boat. But anyway, the biggest thing right now is the new Trump tax law. Whether you hate Trump or not, whether you think this is a bad idea or not, it is the law of the land. And you need to understand the changes so that you can keep as much money for yourself. Everybody can use a little extra money. So what we're going to do right now is just kind of go through some of the key provisions, some of the key changes, and maybe a few different ideas that you can employ to try to make sure you're maximizing your tax deductions. So the first big change to the tax code is the tax rates. And this will actually help everybody. It doesn't matter your income level. Everybody's going to get a little bit of a tax relief on this. So essentially what they've done is they've reduced each of the tax brackets by 2 or 3%. But it's not just the fact that they lowered the tax brackets. They also expanded the amount of taxable income that you can have and still be in a lower bracket. So right now, the way it was structured, we had a 10%, 15%, 25%, 28%, 33%, 35%, and 39.6% tax brackets. So the 10% bracket basically is going to remain the same, but the 15 drops to 12, 25 to 22, 28 to 24, 33 to 32, and then we have essentially the 35 is going to stay the same, and then 39 is going to drop to 37. So you can see right off the top, you got 2 or 3% savings for each bracket that you're in. And that's going to have a big impact. And many of you probably already experienced it in your W-2 pay. So they've already adjusted the withholdings based on the new tables. But like I mentioned before, you're going to actually get more money that's going to be taxed at the 12% bracket that used to be taxed at the 15% bracket. So you're going to get additional savings that way. Same with the 22%. Before it was 25% and even up to 28%. For instance, the 28% tax bracket used to go to $165,000 of taxable income. Well, if you're at $165,000 taxable income with the new tax law, you're still going to be at 22% tax rate. That's a 6% tax savings for you, which is fantastic. And then even if you go to up to $315,000 of income, in the old system that was 33% tax rate, now you're at 24%. So as you look at this, you're going to be saving not only in the effective tax rate, but also the amount of money that's being taxed at these lower rates. So that's good news for everyone. Again, I don't care about your political persuasion. More money in your pocket's more money in your pocket. I think that's a good thing. And again, what you have to do is structure your finance around the rule that are in effect today. So the first thing is, great, we're going to get a little bit more money. But there's been some other changes to income, how they look at income items, as well as deductions. So the biggest changes for the income, the first one is that alimony is going away. So the way it used to be structured is if you got divorced and you were paying alimony, the person who pays the alimony gets to deduct that on their taxes. The person who receives the alimony would have to claim that as taxable income. Now, any divorces that are finalized before the 31st of December of this year, 2018, that's still going to be under the old rules. But starting January 1 of 2019, that's going to be gone. So if you get divorced or your divorce becomes official in 2019 or later, then these new rules are in effect. So if you happen to be the receiver of the alimony, you no longer have to claim that as income. So you're going to come out a winner. If you're paying the alimony, well, you've lost a major tax deduction right there. The second thing that's going to change for a lot of people is how capital gains are treated. Now, this is a very nuanced part of the tax law. But when you buy shares of stock, when you buy shares of mutual funds, anything like that, you used to be able to decide how you wanted your tax gains to be associated. There were a couple different ways you could do it. The first one was called a FIFO, first in, first out, meaning the first shares you bought, when you sold, that's what you used as your cost basis or the amount that you paid. So again, if you bought shares for $50 a share and you sold it for $100, you'd have $50 a gain. Now, if you bought shares for $50 and you bought shares for $75 and then you sold for $100, under the FIFO method, you'd still use the shares you purchased at $50 to determine what your capital gains was. There are other methods you could do. LIFO, last in, first out. So that would be the last shares you bought were the ones you use for your cost basis and figuring your capital gains. So going back to that example of $50 a share, $75 a share, in the LIFO example, you would use $75 as your cost basis, which would lower the amount of capital gains that you have. Well, what's basically happening now is the government is essentially mandating everybody uses FIFO. Now, you can still do other methods, but now it's up to you to decide or to track your basis, you personally. Before, you could tell your broker, okay, I want all of my capital gains to be under the LIFO method. And there's even another method called the average share method. So they would just average all the share cost basis together. Well, now you can't tell your broker how to do it. They're going to do first in, first out. What this is going to do is probably result in more capital gains, unless you're going to take the effort yourself to do a different methodology and then track it yourself throughout your entire life. And it adds a lot of complexity to your taxes. It might make sense if you have some stock with a very low cost basis or stock that you've been purchasing over time. There's a lot of people that do dividend reinvestment plans, so they've been buying stock $50 a month for several years. In those cases, it might be worth the effort. But for most people who are just working with a broker or a financial planner and they've been just buying kind of in blocks over time, they're probably going to end up just doing the FIFO because it's the least complex way, it's the least effort, but it's going to have an impact and probably going to result in more taxes for people. The third thing that's going to be a change to income, and we're going to have another video on this pretty soon, it's a tax benefit for businesses. So now most of the pass-through tax entities, this means if you have a sole proprietorship, you have a partnership, you have an S Corp, or you have an LLC, if you have any of those entities, a good portion of your income is going to be excluded for tax purposes, up to 20% of that. It's a very complex part of the tax law. And again, we will look at this in a separate video and podcast, but business owners are now going to get a little bit of a tax break. And the reason they put this in there is they changed the corporate tax structure. So this is for companies that are incorporated as a C Corp. They have a flat rate of 20%. That's the top tax rate. So they were afraid that all these smaller mom and pop shops, these LLCs, sole proprietorships, and S corporations would turn to a C Corp for tax savings. So they developed a complex calculation to ensure that you as a business owner are going to get the same tax cut that the C corporations are getting. So I think it's a really good thing. But if you're a business owner, you need to take note and you need to plan, because it is kind of a complex calculation. You do need to spend some time really understanding the new tax laws that pertains to small businesses. So those are the biggest changes to the income. There's also changes to the adjustments to income. Now, what are adjustments? Well, you take your total income and you come to a figure called a gross income, and then you adjust that based on different things like IRA, savings, student loan interest deduction, tuition and fee deductions, health savings accounts. There's a whole host of things that actually reduce your gross income, and then you come to what they call the adjusted gross income. Now, if you know anything about taxes, so much of the tax return is based on your adjusted gross income. So there are some changes to the adjustments in the new tax law. So the first one we've already kind of touched upon is dealing with alimony. So people who were paying alimony were able to take an adjustment to their income and write off the alimony. That's not there anymore. So line 31 on the new tax form is going to get rid of alimony paid. Another big one that's going to affect a lot of people are moving expenses. So it used to be if you moved more than 50 miles to a new job, and that's the reason you moved, you were able to deduct moving expenses. You know, obviously shipping your household goods, the transportation costs for you if you're driving there, some of the meal costs, things like that were deducted. Well, that's gone. It's no longer there. The only people who can take moving expenses any longer are active duty military. They're the only folks who are still authorized. Now you might be thinking, hey, my boss or my company pays for my moving expenses, so I don't have to worry about this. Oh, yes, you do. Because here's the thing. Even if your employer pays for your moving costs, this is now going to be included as taxable income to you. It's not just out-of-pocket moving expenses that are gone as a deduction. It's also going to be anything that's paid by your employer is now included as taxable income. This can have a big impact on people. So if your boss is telling you, hey, we want you to move from Seattle to Washington, D.C., which is probably where the new Amazon HQ2 is going to go. So if you're asked by Jeff Bezos to move from Seattle to DC for the new HQ2, and they say, well, we'll pay for your moving expenses, and you're like, awesome, that's great. Okay, they do that, but guess what? Anything that they pay is going to be taxable to you. So it's really not as big a deal, and it might affect some people, might come into play in your decision whether to move for a job. So that's kind of another really big one that's going to be changing here on the adjustments. So now, once we get past your income changes and the adjustments to it, we still have a lot of new changes here. The biggest one is the standard deduction. And before I get into that, I think I'm going to talk just a little bit about some other taxes and credits that are going to show up, because the itemized deduction, standard deduction is a really big item. So the first thing that you're going to see a big difference on is the child tax credit. So this was something where you could get $1,000 per child if your child was under the age of 17. So essentially a 16-year-old or younger, you could get up to $1,000 right off the top, and it's a credit. It's not a deduction, it's a credit. So it's a dollar for dollar reduction in your taxes. Now the bad thing about the $1,000 child tax credit under the old system is it phased out pretty quickly. Once you got past $100,000 for married filing joint, you started to lose your credit. And once you got over $125,000 of taxable income, that credit was completely gone. Well, what the new child tax credit is, it's $2,000 per child. So it doubled. Not only that, the phase out also doubled. So now you aren't going to start to phase out of that $2,000 child tax credit until you get above $400,000 of income. So a lot more people are going to be able to take the full child tax credit, and they're going to be able to do that at double the rate. So that's excellent. The other thing that's really a huge benefit for people is an adjustment to what's called the alternative minimum tax, or AMT. So the AMT was established back in 1986 by President Reagan. They did a massive tax reform back then. And what they tried to do was structure it so that very wealthy people couldn't do a lot of strategies to avoid taxes. So anytime you do a tax return, ever since '86, you run a normal 1040, you do a normal calculation of your tax bill. You also do a separate calculation under the AMT system. Now, for most people, the AMT never really came into play for years and years because it was for higher income folks. The problem that the government made back in 1986 is they never adjusted the AMT tax rates for inflation. So as inflation just naturally increased wages, more and more people ended up becoming subject to the AMT tax. So even people who maybe were making $150,000 were seen as very wealthy people and being subject to an AMT tax. Now, maybe back in 1986, $150K, you were doing really well. But in 2017, 2018, $150,000, while it's still a good salary, it's not quite as much as what it was back in the 80s, especially if you live in a high-tax state like California or New York. So the AMT wasn't adjusted at all for that. So more and more people were paying higher taxes because they were getting pushed into this AMT. So the AMT has been adjusted. Now you won't have any impact on you personally until you get to the $400,000 level. So that's going to help a lot of people out. They also adjusted that $400,000 level by inflation. So as we progress the years forward, decades even, we're not going to have the same problem we had from the '86 tax bill, where people just end up there due to inflation. So that's really good. Both of those are going to help. But the next thing I want to talk about is itemized deductions and exemptions. This is going to be really big. In an effort to try to streamline and simplify the tax code, what this tax bill did was it got rid of exemptions. What's an exemption? Well, for every person in your household that you're financially supporting, you could take an exemption for them. And essentially that would deduct about $3,100 from your taxable income. So if you had 4 people in your household, you'd essentially have about $12,400 that you could deduct straight off the top of your income. If you had 10 kids, obviously you did much better. Well, the new system gets rid of that completely. It's gone. So this is going to negatively impact large families, people who have a lot of kids, or maybe people who are taking care of their parents. Your parents are elderly and they've been deducting their parents as a dependent for years. That's going to impact you. That's gone. They've rolled the exemptions into the standard deduction. Now, the standard deduction, again, is an amount that you can deduct from your taxable income based on your filing status. So filing status, if you're single, that's your filing status. Married filing joint is a filing status. Head of household is where you're single, but you have children or other people that you're financially supporting. You can often take a head of household. It gives you a little bit extra of a standard deduction. And then there's a couple other married filing separate. That's for people who they're married, but they think they might do better if they just get taxed on their own income individually. And finally, there's a qualifying widower filing status. That's if your spouse has passed away within the last 2 years and you have children that you're taking care of. They would let you get a higher standard deduction. So what's happening is the standard deduction is, for all intents and purposes, doubling. So they're taking the exemptions and rolling that into the standard deduction and doubling the standard deduction. This is going to make it more difficult for people to do itemized deductions. Itemized deductions was an alternative to the standard deduction, and it really worked well for people, so they could deduct medical expenses, possibly. They could deduct real estate taxes paid, state income taxes paid, mortgage interest, including home equity lines of credit, and charitable expenses, charitable deductions. So what you always do, in case you don't understand the tax code, is when you did your taxes, you either took the standard deduction or your tax preparer got you to itemize. Well, now with the standard deduction doubling, a lot more people are just going to take the standard deduction and not itemize. The thought behind it is it's going to simplify the tax code, and it does. It does make it a little bit easier for more people just to take the standard deduction. If you've already paid off your mortgage, chances are you're going to be taking the standard deduction because the mortgage interest was probably the biggest itemized deduction that most people took. The second thing that they did on the itemized deductions, which has an enormous impact on whether people are going to itemize or take the standard, is state income taxes paid. It used to be you could take all of the income taxes that you paid to the state as a deduction, or I should say, and you could also take your real estate taxes paid. What the new law is doing is it's capping the state income taxes paid plus real estate taxes to a maximum of $10,000 per year. So if you're in a high tax state like California, New Jersey, New York, where you have high state income taxes and high real estate taxes, well, you're getting hit here because a lot of people might have $30,000, $40,000 of deductions just with their real estate and state income taxes. Well, that's capped at $10,000 now. So that's going to be a big adjustment for a lot of people. Now, the medical is going to remain the same. Medical has always kind of been difficult to take as a deduction because you can only deduct the amount of out-of-pocket medical that was above 7.5% of your adjusted gross income. Remember, I said that AGI figure was a big part of your tax return. Well, here's one area that it does come into play. So you can only deduct the amount above 7.5%. So not a lot of people really ever get to take medical expenses as an itemized deduction. But that has remained exactly the same in the new tax code. So that is kind of a positive. But you're essentially looking at having a tougher time of itemizing, especially if you don't have a mortgage or if you're in a high state income tax state. The other part of your itemized deductions that have changed, the first one that has a massive impact on people is we no longer have any kind of miscellaneous deductions or job expenses that you can deduct. So if you have out-of-pocket expenses for your job, so if you're deducting mileage, if you have to travel for work, if you're doing gifts for clients, if you're doing education, if you have union dues, all of those things are no longer deductible under the new law. Any kind of tax preparation fees are no longer deductible. For me, a financial planner, I had a lot of clients who could deduct the cost to pay me. That's no longer deductible. So any kind of miscellaneous deductions and job-related expenses are no longer deductible. So if you're a member of a union, or if you do have a lot of out-of-pocket expenses for your work, you need to go back to your employer and try to find a way to get them to reimburse you for those things. If you could somehow negotiate that so that they pay for that or offer it up front, that's the only way you're going to get a benefit. Otherwise, you're just losing a tax deduction. They've also impacted the gifts to charity. Not a big change here, but you can deduct up to 60% of your adjusted gross income in any given year for gifts to charity. That figure used to be 50%, now it's up to 60%. If you're giving 60% of income to charity, God bless you, because I don't know how many people have enough income to do that. But maybe you had a one-time big payment, some sort of bonus or something that you're not seeing and you really need to find some tax savings. You've got an opportunity to put more to charity and deduct it. One change they made to charity that probably will affect a lot of people is you can no longer deduct any kind of charitable gift if you get sports tickets in exchange for that. So oftentimes people will give to charity and then they get season tickets to their college football games. Well, guess what? If you do that, you can no longer take that charitable deduction. So what you have to do now is actually pony up and buy your season tickets with cash, and then if you want to give money to the organization, you're going to have to do that as well. So that will have an impact on people. Believe it or not, there's a lot of people that do that, which is probably why they changed it. So if that's not enough changes for you, I've got some more coming at you. So some other little things that are going to be changing here within the tax code. Something that's been very contentious has been the tax penalty for health insurance. So under the Affordable Care Act, if you did not have an ACA compliant policy, you were subject to a tax penalty. And it depended on how much you made, what your income was, what your filing status was. But starting in 2019, they're going to eliminate that Affordable Care Act tax penalty. So depending on what kind of political persuasion you have, some people might say that's going to really hurt the whole ACA as far as viability. But if you were paying that tax, you're pretty happy because now all of a sudden that's gone bye-bye. So you can avoid that completely. Okay, so what other little things do we have? Well, nothing huge. One thing that's being changed is the kiddie tax. All right, so the kiddie tax kicks in if you're trying to put a lot of your investments to your children. Well, the kiddie tax will kick in once they have more than $2,100 of unearned income. Unearned income, again, is going to be dividends, interest, capital gains. It's something where they're not making money due to the sweat of their brow. So once they get past $2,100, they're now taxing the kiddie tax at the estate and trust levels. So that means that any amount of money above that $2,100 is going to get taxed much quicker. Estates and trust, their tax rates go up fast. They go up once you get past $14,000, you're paying the top tax rate of 37%. So you do have to be careful here not to put too much money with the kids or have anything structured so that they're going to be facing this kiddie tax because you'll pay a lot more in taxes. You might want to look at putting, if they do have a lot of money, putting more of the money into a 529 plan. So a 529 plan got a little bit of a benefit here because you can now use 529s for high school and middle school, any kind of private school, up to $10,000 per year. But you'd also still be able to shelter some of this money for college as well if you put it into the 529. Another thing that got changed is the annual gift tax exclusion is now going to go up to $15,000 per year. So what is the annual gift tax exclusion? Well, essentially over your lifetime and then upon your passing, you have a certain amount of money that you can give to your heirs and beneficiaries without having to pay estate taxes. Now, if you give a gift to somebody more than $15,000, you technically have to file a gift tax return and declare to the government that you're using up some of your lifetime and post-lifetime gift tax exclusion earlier on. If you do $15,000 or less, you don't even have to file that gift tax return. You just do it, and it doesn't reduce the amount that you're able to give to your beneficiaries and heirs. I know this is probably a little bit confusing for people. I'll do a video on it at some point. But essentially, what you want to do if you're looking to give money to kids or grandkids, you want to keep it to $15,000 or less. And speaking of the tax exclusion for your gifts and estates, that's going to double for each person. It's going up to $10 million per person. This means that a married couple can essentially shelter up to $20 million for their kids, their grandkids, or whomever they'd like to give the money to. That's going up from roughly about $5.2 million to $10 million. So you have $10 million that you can give over your lifetime as a gift or upon your passing that won't be taxed at the estate tax rate. So that's good. One thing that they did get rid of, and this is a very nuanced thing, it's very small, it's a recharacterization of Roth IRA conversions. You used to be able to convert your Roth from a traditional to a Roth, and then if the assets lost value, so if we had a 2008 and all of a sudden you convert this thing to a Roth, you pay taxes on the conversion, and then it loses value. Well, the government used to let you recharacterize it back to a traditional IRA and then let the money grow back up to where it was. That's gone. So if you make if you take money from a traditional IRA and you convert it to a Roth, that's a one-time decision that can't be changed regardless of what happens to the asset value after that. It's kind of small. You don't see that happen too often. You did see it happen after the 2008, 2009 stock market massacre, but beyond that, it really didn't impact too many people. Okay, are you still with me? Are you still awake? Hopefully whatever caffeine product you were taking is kicking in. We've gone through a lot, but what I want to do now is just give you an example of how it's going to look for a lot of people. What's a tax savings going to be? Who's not going to get tax savings? And then just talk about some strategies that you could do to make sure you're maximizing your tax savings. Okay, so let's take a look at some examples just to give you an idea of what the real bottom line impact is going to be for folks. So we're going to take two families. They're both four members in the family. One family is going to have wages of $100,000. The second family is going to have wages of $250,000. So we're also going to look at the first family having about $8,000 in state income taxes, whether that's real estate and state income taxes or just one or the other. It doesn't matter. Just $8,000 total. Remember, we can only do 10 maximum. The second family of $250,000, they're going to have $35,000 of state tax. The first family is going to have mortgage interest of about $10,500. The second family making $250,000 is going to have $40,000. First family, $500 in charity. Second family will have $5,000 in charity. And the second family would also have just those miscellaneous itemized deductions of about $3,000. So maybe they're paying their tax guy or financial planner a good chunk, or maybe it's just unreimbursed business expenses. So how are these two families going to fare? Well, if you look at the current law before the new tax law, H.R. 1, you can kind of see the two columns. Basically, the bottom line for the family of four was they were going to have around $6,700 of taxes owed to the government. That's their tax bill for the year after you figure in a child tax credit. So that's assuming that both kids were under the age of 17. If they were over 17 but they were still dependents, then the tax bill would jump to $8,708. Whereas the family making $250,000, well, you can notice here they were subject to the AMT. They were right at that $250,000 level. They're being pushed into the AMT, so they have about $3,400 of AMT tax. So their total tax with the kids being under 16 would have been $32,280. And the thing is, they're being phased out of the child tax credit under the old law. So even if the kids were over 17, still dependents, they were still looking at $32,280 in taxes. Big difference there. So how does it look for the for the families under the new law? Well, the first family making $100,000, you notice the first biggie that they get is their taxable income is going to go up from $64,000 to $76,000. Well, why is that? Well, it's because they're now going to take the standard deduction. They're going to lose all those exemptions, which would be a little bit over $13,000. And then they're also going to lose a little bit on the charity. So they were going from a situation, not charity, I'm sorry, itemized. So they were going from a situation where they had almost 20,000 of itemized deductions plus 13,000 of exemptions. Well, now they're just capped at 24,000 total. So that's going to result in 13K more of income. But it's at lower rates. The other thing that's going to benefit these folks is their child tax credit's going to double from $2,000 to $4,000. So if that's the case, their tax bill under the old law was $6,700. It's going to drop to $4,700. So they're going to save almost $2,000 in taxes under the new tax law if their children are under 17. If they're over 17 and they lose that $4,000, well, in that case, they're only going to save around $1,000 in taxes, but it's still a savings. They're still coming out ahead. Now, the family with $250,000 of income, they're going to benefit in that they're going to get $4,000 for child tax credit, whereas before they were phased out completely and got nothing. So they're getting $4,000 more of a credit. However, you'll notice their taxable income is going to go up substantially by $45,000. Here again, they're losing the exemptions of about 13K, but they also had a lot of itemized deductions. They had 40,000 of mortgage interest, 35,000 of state tax, which is now dropping to 10,000. They had the charity, and then the miscellaneous of 3K is gone completely. So they're going to lose $28,000 of deductions right off the top. And then with the other 13,000 of exemptions gone, that's where they're getting hit more. But it's at lower rates. So if this situation, if the children are under 17, this family making $250K is still going to save about $600 in taxes. So it still comes out okay for them. Now, if the children are over 17 or older, that $4,000 goes away. Now they're actually going to be hurt by the new Trump tax bill. They're going to end up paying almost $2,400 more in taxes. So you can kind of get a feel here. It's really going to help everybody in that there's lower rates, but depending on your itemized or standard deduction, that's going to determine if it ultimately helps or hurts you. Lower income folks are definitely going to get a benefit either way, but if you're making above 250K, it really kind of depends on your family status, also depends on your itemized deduction status. That's a little example there. So now, what should you do, what could you do to kind of mitigate some of these damages? Well, if you're in the position where it's more difficult for you to itemize your tax deductions, what you're going to want to try to do is bunch your itemized into 1 year. What do I mean by that? Let's say every year you give $5,000 to charity. You do it every single year. And if you're at that point where you're just not able to itemize anymore under the new law, maybe in 2019 you don't give anything to charity. Now, I'm not suggesting you aren't more charitable or you're a bad person by doing this. What you do in 2020 is you give $10,000. So you're still ultimately giving $10,000 to charity. You're just going to bunch it into 1 year as opposed to another. That's something that might be able to help you do an itemized deduction versus the standard. Speaking of bunching, you can also do that with mortgage payments. So maybe 1 year you add a few extra mortgage payments to the bill just to get that interest. That will also help you kind of increase your itemized every other year. You can do it with medical too. So if you're somebody who does have a lot of medical, more than 7.5% of your adjusted gross income, you could here again try to bunch things into 1 year. So if you know you're going to have some, maybe a knee surgery, some dental work, eye stuff, LASIK, glasses, try to bunch everything into 1 year to maximize the amount of medical in any given year which also maximizes your itemized deductions. So if you do that, alternating, you might be in a position where taking the standard deduction 1 year and then really increasing the amount of your itemized the next year will help you save taxes over time. The other thing to look at, since we're in lower tax rates, is see if it makes sense to do Roth conversions. The thing about these new tax rates is they are not permanent law. They are set where they're going to sunset in 2025. So if it's not made permanent law, and in this toxic political environment, I don't think they can get anything passed, in 2025 we revert back to the 2017 taxes. So that means rates would be going back up. So you have 7 years to look at possibly converting money from traditional IRAs and retirement plans to Roth and using these lower rates. So you might want to take a look at that. The best way to do it, look what tax bracket you're in. If you have more room in your current tax bracket, let's say for instance you have $10,000 until you bump into a higher bracket, you can convert $10,000 into a Roth. So this allows you to build up your Roth savings and not get pushed into a higher bracket. So that's certainly something to look at. Another thing you might want to think about doing, depending on your situation, is ramp up your retirement savings. Now this could just be the financial planning nerd in me. I always like to see people make sure they're putting money into retirement savings. But you might be able to use a Roth 401k option with the lower rates. Gives you an opportunity to do that. Or if you are one of these folks who are going to lose itemized deductions, you definitely need some more write-off somewhere, so retirement savings is a great place to get those. So you might just do traditional 401k or 403b, but you just ramp it up a little bit. So those are just some general ideas. We'll be offering you more as time progresses, but hopefully you'll have a better understanding of the tax code and maybe get a good idea of what you might need to do to improve your tax situation. And again, we're always open to taking questions. If you have any, just leave a comment. We're happy to answer your questions. It could be a great podcast or future follow-up video. So hopefully you got something out of this. Hopefully you're going to save a little bit of money on taxes. Hopefully it was useful to sit and listen to me drone on for half an hour. But the big thing is, right now matters, okay? Especially with taxes. You have to do it in the calendar year. Don't wait to make changes to your situation for tax purposes, because you could lose some deductions by doing that. You got to act right now. Right now matters. So hopefully you're one step closer to saving yourself from Wall Street.